Stocks are down big today, but they're definitely off their lows for the day. At one point, the Nasdaq was down about 1.6%. It's now down about half that, about 0.83, 0.84%. Guys, this is the heat map for the S&P. Look at this one. NVIDIA started the day down, rebounding quite nicely, being one of the largest stocks in the S&P. Obviously, will help rebound that Nasdaq valuation big time. A lot of red here. We have oil and gas being the only one glimmer of hope, along with utilities, but basically everything in oil and gas is up except for TPL. I have no idea what that is. But guys, volatile day. At one point today, our good friend crypto, Bitcoin, was down to 91,410. It is back up to 94,000. Yep, you crypto enthusiasts, it's definitely a hedge. Oh boy, that is awkward because it's definitely not. I mean, look at the Nasdaq now, 0.64. So to start the day, there was fears about Fed rates or whatever excuse they gave as to why markets were going down. I don't know if that's the case. Could it be that people are selling stock in order to take advantage of some year-end tax loss harvesting? What that means is there's a way to make a few extra percentage points a year by selling losers as you sell your winners, offset the losses. Now, there's a thing called the wash sale rule. On the losers, you cannot repurchase them back for 30 days. If you do within that 30 days, the IRS will say you don't get that loss anymore and your basis stays the same. But if you wait 30 days, you keep that loss. So what people do is they will sell a stock for a loss, find a very similar stock, either valued same way or in the same industry that works together, buy that stock. So you take the advantage of the loss, you buy a similar stock. So let's say they work in tandem. If your stock that you sold would have gone up 20%, the other stock would have gone up 20%. So you take advantage of that, still rebound, but still taking advantage of that loss. That's a great way in which you can save a few percentage points a year. Now remember, as I always say, never buy or sell stock purely based on the tax reasons. You're here to buy a principle-driven investment. What that means is we look at every investment as the present value of all future cash flow. We are investors, not speculators. We don't look at Mr. Market and market prices to tell us if we're right or wrong in the short run. And we only buy what we understand, okay? Now, like the people who love crypto, they'll say, I understand crypto, but how does it make money besides just going up and down in value? That's the issue we have. Now, 2024 is coming to a close. Big year for markets, big year for valuations. I repeat this till I'm blue in the face, but it's really important to understand this in terms of where we are in the market cycle. Death, taxes, and cycles. Those are three guarantees of life. Death, taxes, and cycles. Let me show you where we stand on the two most reliable metrics in stock market history. The stock market GDP ratio is considered by Warren Buffett to be the most reliable metric at any given time. And I've updated it today for the third quarter numbers of September 30th. Even though I have 1230 in here, $29.37 trillion in GDP. We're currently 115.5% overvalued. Guys, this doesn't mean sell your stocks. What this means is get ready for having the next 5 or 10 years not be as great as the last 5 or 10. But guess what? The same thing happened from 2000 to 2010, but people who invested from 2000 to 2010 and dollar cost average made a load of money since then. Let me give you an example. If you bought the Nasdaq at the peak in 2000, if that's when you first started buying it, and you dollar cost average all the way, you would have seen your stocks fall 83% from peak to bottom. But you know what? You'd have still made 15% return on your money annualized in that 24-year period of time. That's what makes investing difficult. It's simple, not easy, because it's hard to see stocks fall 83% and you still stick with it. But that's the point of dollar cost averaging. The S&P went sideways from 2000 to 2010. People who dollar cost average along the way saw their stocks fall 50% twice, and they still would have made over 13.5% return since 2000 dollar cost averaging. Guys, it works. Now, we are in a current bubble, but we were starting at a bubble in 2000. So I look at this saying, it works in long periods of time. In fact, let me show you the history, the 20-year history of stocks going back to 1960 to 1980. Here's the compound annual growth rate, including dividends, of the S&P. And the previous 20 years, starting from 1980. So the previous 20 years would be 1960. From 1960 to 1980, 8.3%. But in 1980, valuations were so low, it'd be essentially like the S&P today selling for around 1,000 to 1,200. From 6,000, that's how low valuations were here. And so if valuations were so low, how would returns look for the next 20 years? We'll go to 2000, 15.7%. 99, 17.9, 98, 17.8. So when stocks are low valued, the following returns are high. When stocks are high valued, like in 2000, going 20 more years, going up to 20, 7.5%. And that's with a very, very strong bull market. That's what's amazing, guys. 2004, valuations were low. 24, about 10.5% return. So guys, there's not a single 20-year period in which stocks were down. Doesn't mean that's going to happen in the future. Because look at the Nikkei in 1989, hit 40,000. It didn't hit that high again until this year. That's 34 years. From December of 89 until now, it was essentially break even from an index level. Again, though, what matters is valuations. That's what we teach all the time here. Doesn't mean you stop investing, because all along this way, if you kept investing, you would have made way more money than the average market return just by dollar cost averaging. And if you were aggressive enough and put more money in when valuations was really low and waited for valuations to catch up, you did very, very well. Again, this doesn't mean to pull your money out. What it means is just be ready for okay returns for a while as you dollar cost average. Just remember, we do mean revert. It's okay. You will do great. Now, if you plan on retiring in the next 5 or 10 years, might be time to pull some money off the table just to make sure, because the extra 20 or 30% might not be worth what could be lost. But if you have 20 years or more, just thank your lucky stars and say, I'm going to get in the habit of dollar cost averaging every week, month, year, whatever it is you do. Make sure you do that. So guys, a year ago now, we were expecting 7 rate cuts in 2024. We got 3. Quarter point, half point, and quarter point for a total of 1%. The markets are expecting another at least 2 or 3 cuts for 2025. The honest truth is we have no idea. Could be more, could be less, could go up. It all depends on what's going on with the economy. I will say this. If inflation starts to rear its ugly head again, don't think for 1 second they won't raise rates. Absolutely they would. But a great investor, a good investor, a principle-driven investor does not care about where interest rates are at any given point. What they care about is making sure that they buy good stocks at good prices, that they buy individual stocks, and they stick to their plan of dollar cost averaging. That's what will make you a great investor. Learn from those mistakes that were made. I always tell people, I'm very grateful that I have 1,000 apartments and 8 or 9 businesses upstairs that are growing in value, because it has really grown a lot of my wealth here as I wait for stocks to stay at the valuations. But remember, it's okay for me to stay out of the market because I have real estate and businesses upstairs where I don't need to make great returns. I own 24 companies right now and 2 ETFs. And I'm going to be adding SCHD to my portfolio, but I'm not going to be putting it in lump sum. I'm going to dollar cost average in. How long? Until valuations make more sense where I can dump more money in at one time. That's my process. But that doesn't necessarily work for you because I, again, have every single business upstairs I could live off of. Every piece of real estate I have upstairs, I could live off of. So for me, it's about preservation of capital and not growing at an absurd rate per year. Now, our analyst, Dalton, who's very young and not worth a lot of money, he takes highly concentrated portfolios because he is okay doing really, really deep research and making really outsized returns by holding 5 or 6 stocks. I'm not the same way. He owns companies that are less than $500 million in market cap. I want to own $20, $30 billion plus companies that I think will be around for a long period of time. He will do better than me from a stock investment standpoint. But we're in very different situations, and that's part of being a principle-driven investor. Know your situation and what you need to accomplish. If you don't need to make 20% returns, don't try to. It's going to take more risk than you want to. If you're going to have plenty of money following the market, then just follow the market. It's a great way to live, unless you find amazing satisfaction and you have the emotional ability to stay in stocks. So for 2025, guys, it's really important. Stick to this. Stick to what a plan that works. Learn more about investing. And if you want to become a really great investor and have the tools to do so, join our community. $7 for 7 days. We're making major changes. So make sure you sign up now before we make those changes so you can lock in your pricing tier and the software forever. Go to everythingmoney.com or click the link in the description below. Thank you very much for your time.